Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LINEAGE INC quarterly report. LINEAGE Inc. offers a range of businesses and services that cater to the needs of its clients in the food and beverage industry. The company's key offerings include temperature-controlled warehouse facilities, end-to-end supply chain solutions, technology integration for enhanced distribution efficiency, sustainability-focused services to minimize waste and reduce environmental impact. These services are provided across a network of over 485 strategically located facilities globally, covering North America, Europe, and Asia-Pacific regions. The significant drop in LINEAGE Inc.'s stock price over the past year can be attributed to a combination of factors. The company's Q3 2025 earnings report revealed a loss per share of $0.44 and a net loss of $112 million, despite a 3% increase in revenue. This was followed by lowered full-year guidance due to decreased import/export activity and less new business in the U.S. for the fourth quarter. The cold storage and logistics sector is also facing headwinds due to excess capacity and uncertain trade conditions, with an estimated 9.5% excess capacity in the market. High food prices have further negatively affected customer inventory levels, contributing to a challenging environment for LINEAGE. Analyst downgrades and price target reductions have also played a role, with several financial analysts lowering their price targets or downgrading the stock due to operational challenges, demand weaknesses, and broader macroeconomic uncertainties. As a result, the stock has hit 52-week lows, reflecting a substantial decrease from its 52-week high. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by inflationary impacts on operational costs, leading to customer rate increases, overall demand growth in retail and food service, uncertainty and aggravated inflation caused by tariff and other trade policies, increase in non-same warehouse pool and foreign currency translation. On the other hand, revenue decline is primarily driven by divestiture of Spain transportation business, resulting in a loss of $60 million, lower transportation volumes, sale of Spain transportation business, leading to an impairment of $28 million. Net income and profit margins, a turning point. The financial performance of a company has shown significant improvement in recent quarters. Net income has improved by $431 million for the 3 months ended September 30, 2025, compared to the same period in 2024. This trend continues with an even greater improvement of $552 million for the 9 months ended September 30, 2025. Profit margins have also seen a substantial increase, from -8.1% to -2.9% for the 3 and 9 months periods respectively. The significant reduction in provision for credit losses and other operating activities is attributed to this improvement. This shift indicates a more stable financial position for the company, suggesting that it may be on the path towards recovery. The company's financial performance indicates a significant improvement in its ability to generate operating cash flow, with a net cash provided by operating activities of $627 in 2024, an increase of $181 from the previous year. It is clear that the company is on a positive trajectory. Furthermore, confirmation on page 101 that the company has generated positive operating cash flow for both 2023 and 2024 solidifies this conclusion. This trend suggests that the company's financial health is improving, allowing it to generate sufficient cash from its core operations. The company's financial summary reveals significant changes in its debt level and interest expenses. The total debt has increased by $992 million, from $4,976 million to $5,968 million, while long-term debt has also risen by $1,019 million, from $4,906 million to $5,925 million. However, a contrasting trend is observed in interest expenses, which have decreased substantially. The 3-month and 9-month periods both show a decline in interest expense, net, with the latter decreasing from $369 million to $195 million. Additionally, the average effective interest rate of outstanding debt has dropped from 6.4% to 4.3%, indicating a reduced burden on the company's finances. The company's financial performance varied across different segments and regions. The Global Integrated Solutions segment stood out as a top performer, with revenue growth of 0.3% and NOI increase of 16.1%. The warehouse services segment also showed resilience, with a 2.3% revenue growth. On the other hand, the global warehousing segment struggled, with a decrease in NOI by 3.6%, while the warehouse storage segment experienced a decline in revenue growth by 0.7%. Regionally, North America saw mixed results, with higher physical occupancy levels in the first half of 2023, but lower occupancy and throughput volume in the second half due to customer rationalization. Europe's power costs stabilized after increased costs in prior years. Outside North America, certain markets experienced higher occupancy and throughput volumes, but new supply coming online is expected to decrease performance. Management's outlook and strategy overview. Management is optimistic about the company's growth prospects, citing opportunities for expansion into new markets and business lines. They intend to implement their business strategy through strategic acquisitions and investments in technology to boost productivity and customer experience. Key highlights of management's outlook include stable pricing for the remainder of the year, increased occupancy levels in the fourth quarter due to holiday demand, focus on energy-saving initiatives to mitigate power price fluctuations, investment in information technology to drive growth and improve efficiency overall. Management is positioning the company for long-term success through strategic investments and a focus on operational excellence. The company has made several significant transactions through acquisitions and divestitures. In terms of acquisitions, the company has incurred contingent consideration totaling $14 million in 2025 and $13 million in 2024. However, no specific companies or assets were mentioned. On the other hand, the company has engaged in various divestiture activities. These include exiting non-strategic operations, disposing of property, plant, and equipment, which resulted in gains or losses, and selling previously depreciated operating real estate assets. The company has a history of paying dividends to its shareholders. In 2024, it paid out a total of $481 million in 4 quarters. The dividend amount started at $0.38 and increased to $0.05,275 for subsequent payments. This indicates that the company is committed to returning value to its investors through regular dividend distributions. Concerns about inventory buildup and supply chain disruption. A mixed picture. The financial summary highlights potential risks to supply chain operations, including disruptions due to tariffs and trade policies. However, regarding inventory buildup, the picture is less clear-cut. While there are instances of fluctuating inventories, with a decrease in 2024 followed by an increase, these changes may be part of normal business fluctuations rather than cause for concern. The overall assessment on page 64 suggests that no significant concerns exist about inventory buildup or supply chain disruption. Nevertheless, the presence of potential risks and mixed indicators warrants continued monitoring to ensure smooth operations and mitigate any future disruptions. That concludes the financial summary for LINEAGE INC. Feel free to comment below, and I will be happy to answer them when possible.